and welcome to today's webinar on ESG, hosted by Lombard Odier. My name is Emma Cuthworth, I'm Head of Marketing Strategy, and I'm here with Lombard Odier, who is our Head of ESG Solutions. Before I hand over to Robert to talk us through in a little bit more detail our approach to business practices, just by way of introduction and a bit of background, Lombard Odier, we believe that the next economic revolution is underway, and this is a revolution based around sustainability, which we think will be the big driver of returns in the future. We think there are 5 key megatrends that are structural and long-term in nature that will transform our economies and obviously the companies that drive them. And those trends are around demographics, natural resources, climate change, inequality, and the digital revolution. And any transition on the scale that we're talking about here will naturally create risk for the unprepared, but it also creates great opportunity. And in the face of that transition, we have to adapt, innovate, and rethink our approach to investment. At Lombard Odier, we look at sustainability along a 3-pillar model, and those pillars are the sustainability of a financial model, the sustainability of business practices, and the sustainability of business models. I'm not going to go into those in huge detail, but you will find on our attached to this the forum online a place to download a brochure which will give you a much more in-depth look at how we picture sustainability. So, Robert, just before we go into any depth on your slides, could you just give me a bit of the context here? Why is it that we focus on business practices as one of our key model pillars?
Well, hello everybody, hello to the audience, and yes, Emma, this is a very good question to start with, because actually that's something we've been asking ourselves for quite a while now, because we, as asset managers, we've been crunching financial figures and financial data for years and years to try and make our selections to invest for our clients. And what we've understood quite a while ago now is that also practices and behaviors of companies could also be a matter of risk or opportunities in the financial markets. And therefore, it's very important to understand how a company is practicing their business, to understand if it will be a risk or if it could be an opportunity for this company and this investment. So back at Lombard Odier, back in the 1997s, we were starting already scoring companies on the ESG side, which was at that time the best way to understand how a company was behaving versus the environmental, versus the social, and versus the governance concerns. We believe that a company which is using their resource properly and which are dealing properly with their employees and having a fair governance, these companies will outperform on the long term other companies. So I think practices and behaviors of companies are very important to make your investments, and we've decided to integrate this in our investment process, and this is what you call the second pillar of our sustainability approach. So let me just go in a couple of minutes to explain to you how we've came up to the different tools and methodology which helps us and our portfolio managers to select the good investments and good sustainable investments. So as I said, in 1997 we were already scoring companies. We were using a couple of criteria here, about 30 criteria, which were showing different practices in companies, such as use of resources, such as coverage of employees, social coverage of employees, and also independence of boards of companies. Now, we have been practicing this scoring for quite a long time now, because 97, that makes it about 11 years now. 21 years now, and over these 21 years we've improved this methodology. We have started by rating ESG like everybody, and after practicing this for a while we understood quickly that a lot of large international companies, I would say, were heading the scorings, and that's not exactly what we were looking for, and we understood that these companies were spending budgets and communication and marketing budgets to make everything look green. And that's not exactly what we were looking for, so we went into our methodology, scratched our heads and came up with something totally different called CAR. We call it CAR, not for one of these carbon emissions vehicles, but for consciousness, action and results. So CAR enables us to understand in all these companies which are the companies which are really doing or creating an impact, positive impact, or reducing their negative impact, versus these companies which are only doing the talk and which would be considered as greenwashing. So we would look into these companies, and we're looking into all this information that we're collecting, but a different way. We're not only looking at it in terms of environmental, social, and governance, but we're looking into this information and looking at it as consciousness information, action information, or result information. So we built this sort of double tagging system for each data point that we've collected on companies, asking ourselves each time if it was linked to consciousness, action and results, aside of is it environmental, social and governance. And doing this, we were able to break down an ESG score of these companies, not only in the classical ESG space, but in the consciousness, action and results space. And we could see between two companies, now if a company's got a score of, let's say, 70 and another one has got also a score of 70, if we break down these two companies in the ESG space, sometimes we don't see any differences. But sometimes we could see differences when we break them down in the consciousness, action and results space, where we could see a company which has built their strong ESG score by only consciousness, and some which would be only on results or with strong results. And that is exactly what we're looking for, because we are aiming to invest in companies which are really obtaining results of all their ESG actions that they're taking, and not only just giving the talk about what they want to do or what they're looking for to do. So we're really looking into results. That said, that was the first improvement of our methodology, switching from the ESG classical methodology to the ESG/CAR breakdown that we implemented since 2012. And more recently, in 2017, we came up with the same mapping system, but we were mapping all our data points. We mapped them towards the SDG space, the Sustainable Development Goals of the United Nations. And therefore, we could come down with a breakdown of our ESG score in all these 17 sustainable targets. So that is something which is giving us a fantastic opportunity to understand more about the business practices of the companies and how these business practices are aligned with these different sustainable development goals. So that said, to come up to this methodology, of course you need raw data, and the raw data is one of the important part of our process. So we've been collecting information from various sources, and first of all, in 1997 we were collecting the information ourselves, sending questionnaires to companies. Then afterwards we went through data providers. Now we're looking into alternative sources of information. But basically what's interesting in there is there are more and more information available. So we need to get this information in more and more. And also what is very important is to challenge this information, because as a lot of people know today, that this world is not an audited world. So ESG is self-disclosed information for a large part of it, so we need to challenge this information. So it's all about using the proper information, challenging it, and building proper methodology. And once we get all this information, of course, we have set this methodology, building our ESG scores. But we also have set up also other indicators, which we call controversy indicators, and which is using information which is coming from independent sources, which are coming not anymore from companies, but which are coming from medias or NGOs, and in order to have an independent view on these companies and seeing how their practices are positive or negative. These indicators, controversy indicators, are scaled like a hurricane indicator from 0 to 5. And when we look into this, when we get levels 4 and 5, there's really sort of very high levels of risk for drawdowns or reputational risk. So this is also something that we've been working out over these years. Once we've got our scoring methodologies right, we've got our controversy indicators also available for our teams, well, then we're going to look into reporting all this information to clients. So we need to build metrics enabled to show the client, the investors, how their portfolio is improving on these extra financial metrics. So for instance, we're calculating carbon footprint on our investments. We're also calculating water footprints, and we are looking into other impact metrics. These are what we call the impact metrics. So this is what we've been doing over the last 21 years. Building scores, scoring methodologies, looking into company independent information through NGOs and media, like enabling us to build controversies indicators, and also all this information, turn it into reports that we could feed to our investors for them to understand how we are improving the metrics of their portfolios.
Fantastic. Thank you very much for that. A few questions for you, if I may. You mentioned already that you rely on raw data. What's the importance of raw data versus buying in a third-party rating?
Well, as I said, I mean, there's a lot of, well, we started in the early days collecting that information ourselves. And that was very, I would say, time costful and resource costful. We were looking into 30 names on the Swiss market, and we had 7 people out there going collecting the information. So that's not at all a scalable model when we're looking into investment universe large of thousands of names. So what we looked into is providers, and we saw that there were new companies out there which were collecting all this information and selling them. So we could have acquired all this information at less cost, of course, than hiring more and more people to collect this information ourselves. So these data providers, I'll call them data providers, rapidly were also coming out with their methodology and selling their methodology, selling their scoring methodology. But we always followed the route to get to the most granular piece of information that we could find on companies. That means the equivalent of all the answers given by companies to the extra financial questions which have been asked to them. Because if we get that level of information, we could build bespoke solutions, and this is very important. Because if you only acquire information on its refined stage, such as an ESG score provided by whoever data provider they are, well, you cannot control the methodology. You're buying the methodology of someone else, and therefore you cannot build or assess exactly what you want to assess in accordance to maybe your client values. So it's very important to have the smallest little part of information, therefore you can start building your bespoke solutions. Now, that said, all this information that we are collecting, as I said, needs to be challenged. Now, challenge that information is done, of course, by the data provider. When he's collecting this information, he's making his checks. But on our side, we're also checking all this information by checking the continuity of this information, looking and searching into the jumps or the gaps of data, making sure that everything is consistency. And if there's a huge move on one of these data points, well, we'll look into it and understand why that happened. So that's our second line of challenge. But there's a third line of challenge, which is more and more important, is because all this information, we are passing all this information towards our our financial analysts and our portfolio manager team, which are in contact with the companies, and when they have the companies on the phone and they're talking about extra financial views, well, they've got all this information. So that's another challenge, because the company could answer if we got something that we pointed out through the data, we could get to the company and ask a couple of questions about this, and therefore that's our third line of challenge.
And how does the data, or indeed the process, change whether you're looking at a corporate or a sovereign?
Well, the methodology is the same. That means that we are looking into a bunch of information that we categorize in environmental, social, and governance concerns, but we also take the same information that we categorize also in the consciousness, action, and results level. We also tagging it also into the Sustainable Development Goal space, and that's pretty easy because these goals have been defined for governments. But when it comes down to the feeding of this methodology, the data set which is feeding this methodology is different. Of course, it's not coming from the companies, but it's coming from, most of it is coming from World Bank information, but it's also coming from think tanks, from universities, from very large, very big NGOs. So all this information is collected and all put together to build the same type of methodology. That means scorings with ESG score, consciousness, action, result score, and an SDG score.
Thank you. And how are portfolio managers actually using this data? Is it exclusionary? Is it a best-in-class approach? How are the teams actually putting this into the decision-relevant space?
Well, for years, for decades, or even for centuries, fund managers were integrating these ethics or ESG information through exclusion strategies, and that has been the most easiest way to do it. So, I mean, I don't like this, so I just avoid it. Well, that is not the smartest strategy that we have, because if you avoid, if you exclude, well, you cannot influence. And if we want to be responsible investors and building sustainable portfolios, what we need to do is to address the business practices of these companies. If they are good and reliable, we will go into them. That's our sustainable second pillar, looking into business practices. But if these business practices are not good, we need to be able to get back to the company and try to make them change these practices to make it good. Because maybe on our two other pillars of sustainability, these companies are a very good opportunity because they've got a fantastic financial model and they've got a very good business model. They just have poor business practices. So it's up to us to dialogue with this company using our stewardship, dialogue, engage, and have them change their behaviors. And therefore we could extend even our investment universe to more and more companies. So it's very important that exclusion as a single strategy is not the smartest way, but it's using exclusion with stewardship. Maybe that's better, but if you were using your stewardship, then you must not only exclude, you need maybe to underweight, overweight, and therefore you're moving progressively, you're moving into a best-in-class type of strategy. And that's what usually has happened. People have pulled out from exclusion to go to best-in-class. But the next step, which I believe is what is coming up more and more, and this is the route that we have decided to take at Lombard Odier Investment Manager, is to integrate it. And integration is going one step forward than best-in-class, which means that you're going to put in all your investment decision-making, you will integrate ESG concerns. That means you're going to figure out on each of these information that you have how this is going to be a risk or opportunity for the company. If we're looking into carbon emissions, that means that you maybe are going to look into the carbon emissions and the impact that that could have on the P&L if any carbon tax comes out or if anything happens around pollution or whatever. So it's important to integrate this, and to integrate this, it's very important to have, once again, the raw data, the best granularity in your level of information. If you get just the ESG score, you cannot get all this information in order to integrate it properly.
Okay, thank you. One of the criticisms that we hear in the press, for example, around ESG data is it's obviously historic in nature and therefore backwards looking. How do you answer that question?
Well, that's one thing we are doing. I mean, that's led to our change of methodology in 2012, where we switched to this consciousness, action, and result methodology. We wanted to integrate a little more dynamic view than just a static view, just a picture of where a company is standing in ESG. Now, if we look into consciousness, action, and results, we could look how this is moving over time. And when we look into a company today, we're going to look at its profile on the consciousness, action, and results breakdown, but we're going to look at this and compare it to a year before, 2 years ago, or even 5 years ago, and see how that profile is evolving. And that is where we could sort of pick up a sort of ESG cycle of the company, where we could see that the company which is starting getting involved in ESG will have a strong consciousness score to start with, few actions, and very, very poor results. And after a while, they're getting more trust in what they're doing, they'll start taking actions, and after a while, these actions are going to produce results. So you could see a sort of evolving and a dynamic, and therefore that helps you understand where a company is standing on the ESG learning curve.
And what happens if you identify a company who consistently remains at the early stage, for example?
Well, if a company remains with a strong C, a poor A, and a very poor result component over years, well, I would say that's an evidence of this is a greenwashing company. I think that's what we were trying to achieve when we came out with this breakdown, consciousness, action, result, is to make the difference, to separate from companies which are showing a good ESG score, to separate the greenwashers of the others.
Okay. You mentioned bespoke solutions a moment ago. How much can we create bespoke solutions around the SDGs? Could a client, for example, pick just one or a selection that are interrelated around climate, for example? Is it possible to get to that level of bespoke?
Yes, we can, because we can, for each company, we can score the company's practices in the 17 SDG framework. So that means that we can tilt a portfolio towards companies which business practices are more aligned to one of these 17 or a bunch of these SDGs. And this is very useful actually when we're dealing with clients which have got clearly identified their values, it could be foundations or whatever, which used to ask before for mission-related investments. But therefore, with this framework of having all these SDGs, we could tilt our portfolios towards the SDG which is the most linked to their values or to their mission. And that makes it much more clearer framework to work and also for managing the assets.
Okay. A couple more questions from the audience, if I may. One of them is, what's the effect on risk and return of integrating ESG?
Well, there's a lot of studies about that. That's a very, thank you for that question. I think it's, I've had that about 100 times, that one. But yes, I think there's 75 studies which have tried to establish correlations between returns and ESG scorings over time. And there's a 76th study which came out, I think, last year or 2 years ago to summarize the 75 others. So basically that says, well, there's no real evidence that ESG is or destroying or adding returns over the last 10 years. So what we said, well, we'll do, this is not very helpful, so we did our own study with our own methodology, our own scores, and what we noticed is, of course, of over 10 years, well, the ESG score doesn't tend to add any kinds of returns or destroy any kinds of returns. But what we saw, and that is interesting, is we saw that since the last quarter of 2015, Therefore, investors seem to be integrating ESG in their selection because the best ESG scores are overperforming the worst ones. And it's very strong on the statistical side of the study that we've done that shows it. So it seems to be that something happened in the last quarter of 2015 which has triggered this maybe change in the behavior of the investors. And when we think about it, what happened in the last quarter of 2015 had good reasons to trigger this, because you had, on one side, you had the Paris Conference for Climate, which I think was held in October, November 2015, but you also had at the same time the Dieselgate with Volkswagen case came out. So that shows how risk could be something important and could happen to even the very large blue chips in the European markets. So a company like Volkswagen dropping 20% on such scandal, that helped people understand that you have to look into behaviors, because financial analysts couldn't really anticipate this because it's a fraud. It wasn't in the figures, but it wasn't in the balance sheets. So that's something left to people which analyze behaviors, which are the ESG guys.
Of course, and we had also in 2015 the
yes, the SDG, of course, the SDG was also introduced. The SDG model was framework was introduced a couple of months before the Paris conference. But I think it's interesting to see that all these events all happened in the same quarter, basically, and that was something which really created a huge buzz. And seeing these governments stepping in to change, to try and fight the climate change, and seeing companies like Volkswagen with such practices leading to such scandals, well, that sort of pulled the trigger.
Okay. Last question, if I may, and again this one from the floor. Could you outline a little bit about the ESG team, or the business practices team at Lombard Odier?
So, as I said, when we started in 1997, there was a lot of people working in that team, but they were working just to collect data. So that changed. So we prefer use people to do more value-added work. So we are today, in our team, we're about 7 of us, fully dedicated to ESG purposes. But we're using what I would call ambassadors, which are people in each investment team. There's one person which has been designated by the head of the team and myself, which is giving us part of his time, up to 30% or more of his time, for all this ESG concerns. So basically we've got a representative in each investment team, plus support teams. And therefore, this is it's very convenient to be able to push our methodology down into the team for integration, and also collect information from the teams up in order to improve all our data sets, or our methodology. Now, it's been working like that for now almost 6 years, and we're very happy with this operational organization.
Okay. Well, thank you very much for that. We'll draw to a close there unless you want to make any final comments.
No, I'm okay with this.
Fantastic. Thank you. At that point then, I'll just remind everyone that attached in Bright Talk is a brochure called The Sustainability Revolution, which outlines Lombard Odier's view on sustainability. And to thank you all very much for listening today.